Hi everybody. So we've gone through the fact pattern at this stage and we're familiar with our three main transactions being the sale, the new and the existing. In this question, I will take you through the deferred tax balance sheet approach or deferred tax statement of financial position approach. This is a long video and will require immense brain power, so please go through my prior videos and watch the content if you are unfamiliar with the scenario. Part A, in respect of plant only, calculate the opening and closing deferred tax balances and deferred tax adjustments for the year ended 31 December 06. Your calculations must be presented using the statement of financial position approach, must clearly indicate whether the opening and closing balances are assets or liabilities. As we progress with the different legs in the timeline, what is going to happen is that our deferred tax balance sheet table will expand. We can firstly start with the basics with what we're given. We know that as at 1 Jan 04, our carrying amount, which is the same thing as our tax base, is equal to our cost of 500,000 rands. In terms of the way how I draft my deferred tax table, bear in mind that this blue area is a compulsory area because as we progress forward, we will have more info on the right-hand side of your tax base column, whereas your light green area that has your remaining useful life and your remaining useful tax life, that is a nice to have. It just makes it easier for us to keep track of things as we progress. So your next step is basically to bring your carrying amount from 500,000 rands as at 1 Jan 04 to a new carrying amount and a new tax base as at 31 December 05 or 1 January 06. So can you guess how this works? If you don't, please refer back to part 1 of my video that talks about your depreciation formula. So right now we need to account for depreciation of 2 years as well as wear and tear of 2 years. How do we do that? Let me take you through the formula. Depreciation is equal to your opening carrying amount of 500,000 rands less your residual value of 0 over your remaining useful life of 60 months times the period used of 24 months to give you 200,000 rands. Whereas your wear and tear is equal to your opening tax base of 500,000 rands divided by your remaining useful tax life of 48 months multiplied by 24 months used to give you 250,000 rands. So just bear in mind that your wear and tear is apportioned, but in this case, because we're dealing with 2 full years, it's not really applicable. At this stage in your table, you have a carrying amount as at 31 December 05 of 300,000, your tax base of 250,000. Once you have your carrying amount and tax base, it is now time to work out your temporary difference. How do we do this? We do this by taking your tax base of 250,000 and subtracting your carrying amount of 300,000 to give you a temporary difference of 50,000. The next thing that you need to do is to multiply your temporary difference by your tax rate. But which tax rate do you use? As you can see at the top of the table, you have 35% changing to 30%. So the rule of thumb is that you always multiply your tax rate by the old rate of 35% first. Okay? And 50,000 multiplied by your rate of 35% gives you your deferred tax rand value of 17,500. And just make sure that you are consistent in the manner in which you calculate your temporary differences as well as your deferred tax. In this example and using this approach over here, negatives denote liabilities, positive amounts denote assets. The question did state that you must clearly indicate whether the opening and closing balances are assets or liabilities. So just make sure that you don't lose those easy marks and just denote simply DTA for deferred tax asset or DTL for deferred tax liability. Now that we are aware that as at 31 December 05, our deferred tax liability is sitting at 17,500. If you look at your timeline, there's two very significant things that happens at this point in time. One is there's a change in tax rate, and the second thing is that even though you have a carrying amount of 300,000, remember you're going to also need to revalue your asset to 420k. So how do you do this? Which one comes first? Which one comes second? Your tax rate change always needs to be accounted for first, followed by your revaluation. So let's do this, people. Let's do this. So the first part is very simple. If you have a temporary difference of 50,000, you multiply it by the old rate as you've done of 35%, it gives you 17,500. To deal with the rate change, you simply take the 50,000 multiplied by 30% to give you your new deferred tax liability of 15,000. The difference between the two is 2,500, which is a movement. Bear in mind that balances go onto the balance sheet and movements are items that hit your income statement. Movements are items that you journalize. After dealing with the tax rate change, we now have to deal with the revaluation. Your fair value of 420,000 rands only impacts your carrying amount column. Your tax base will remain the same. Thus, at 1 Jan 06, your carrying amount jumps from 300 to 420. Your tax base remains at 250. Your new temporary difference is 250 less 420 to give you 170 times 30% to give you 51,000. Your negative denotes a liability. Thus, the balancing line is your revaluation, 420 minus 300 to give you 120. There's no change in your tax value. Your temporary difference changes by 120, and the movement of 36,000 we journalize at a later stage. Your deferred tax table is meant to amalgamate all three scenarios, being your existing, your sale, as well as your new. We're now going to take a break from your existing and focus on the sale, because remember, it's your sale that occurs at the middle of the year. But before we account for the sale, we first need to bring our carrying amount and tax base from 1 Jan 06 up until 1 July 06 before we account for the sale. How do we do this? This is plain and simple. So by now you should know your formula. Your depreciation is equal to 420 multiplied by 6 months used over 36 months, which is your remaining useful life as at 1 Jan 06 to give you 70,000. Your tax base of 62,500 is equal to your opening tax value of 250 multiplied by 6 months used divided by your remaining useful tax life of 24 months. The rest of the table is straightforward. 62,500 less 70,000 gives you 7,500 multiplied by your new rate of 30% to give you 2250. You then calculate your subtotals as at 30th of June. 420 less 70 gives you 350. 250 less 62,500 gives you 187,500, and you do the rest for the other columns. As at 30th of June, before we account for the sale, we have a deferred tax liability of 48,750. Now that we have new balances as at 30th June 06, we now need to account for the disposal. The question simply told us on 1 July, plant with a book value of 140, tax value of 75, was disposed of at a profit of 50,000. So for the purposes of this table over here, the 50,000 profit is irrelevant, but what is relevant is your carrying amount of 140 and your tax base of 75. It's quite easy and straightforward. You simply subtract 140 from your carrying amount and 75 from your tax base. By now you would know how to get your 65,000 and your 19,500. You then calculate your new subtotals as at 1 July 06 and complete the rest of the table. After accounting for the sale, the third leg is to now account for the new plant that was acquired. Remember, the question says that and was replaced on the same day by plant costing 200,000. This replacement plant is estimated to have a residual value of 20,000 at the end of its expected useful life. Okay, so how do we do this? What do we do next? Simple. And addition is straightforward and super simple. Let's do this. You simply add 200,000 to your carrying amount and 200,000 to your tax base. If you look at your remaining useful life column, right, you just need to bear in mind that your new plant, the remaining useful life is denoted in a dark blue color compared to the purple font for all the other items. And that's a very important thing that we need to do, because remember, the manner in which how we depreciate the new plant, the variables involved in how we depreciate the new plant is different to the variables that we use to depreciate your existing plant. So after you bring in your addition, you then get a new subtotal of 410,000 being your carrying amount and 312,500 being your tax base. What's next? That's right, depreciation is next. You next need to depreciate your plant. But remember, previously when we depreciated plant, we did it in one go. But now you need to do it separately. You need to separately account for the old depreciation of plant and separately calculate the new depreciation of plant. If you do it together, you will confuse yourself and you will end up with the wrong answer. And this is another reason, ladies and gentlemen, that makes this a hot question. So your depreciation on the old is your 210,000. Yeah, it won't be your 410, it will be your 210 multiplied by 6 months use over your 30 remaining. Your wear and tear on the old will be 112,500 multiplied by 6 over 18, not 6 over 48. And that's how you get 42,000 and 37,500. Your depreciation on the new will be 200,000 being your cost, less your residual value of 20,000 multiplied by 6 months over your remaining useful life on the new, which is 60 months. And your wear and tear on the new will be 200,000 multiplied by 6 months used divided by your remaining useful tax life of 48 months. Thus, your carrying amount as at 31 December 06 is 350,000, tax base 250,000, and we have a deferred tax liability of 30,000. This is how your final deferred tax table looks. In part A of this question, we have covered multiple items. We've covered a tax rate change. We've covered a revaluation. We've covered a sale of plant. We've covered an addition. We've also learned to split depreciation between the new and the existing. Are we done yet? Nope. Unfortunately, we are only 75% there. So stay tuned for more, as this question is about to get hotter.